Hello, this is John Kvale of JK Financial. Thanks for watching the video in advance. This is our second of the kind. We're learning. Hopefully you've enjoyed the intro and you've enjoyed the first one. We're looking forward to doing many more of these. In this one, we're going to move on to the screen due to your requests, recommendations, and suggestions. So here we go. Here's your March video. Thank you very much. In this March review video, I'm going to actually just go right to the blog site, and hopefully you'll be able to see some of this. Our first point, looking back in March, that we thought as earnings season finished up, those that follow us have seen and heard us crow about what's expected throughout the rest of the year. If you see these bars, it's unimportant the numbers. I'll tell you the numbers, but this is the earnings expectations here of the S&P 500, our favorite large company index. We like that one because it's a good global macro indicator. Here's the deal. Expectations are embedded in the current market environment, and these are the expectations, what the remaining portion, Q2, Q3, and Q4 of 2013. Bear in mind, capital markets look forward and have an expectation in them. If these numbers actually turn out to be better, we would expect, all other things being equal, the markets are in pretty good shape, and they may even go higher. However, we do not expect these earnings to come in this appreciably higher than they've been over a very long time. We don't, based on the sequestration, based on the taxes, and based on a global late cycle recovery. If our expectations are correct, we would expect them to come in upward, but not near this high. And that would mean, all other things being equal, that potentially the capital markets here, again, not guaranteed, but potentially are slightly overvalued. Maybe to the tune of 5 to 10%. We're not calling for a 25% correction. You see a 25% correction, something like that, that would mean earnings expectations were going down. The markets can stay dislinked for quite some time. We were just wanting everybody to call to attention. The next thing that we found very interesting over the quarter was this is the 10-year. And this is the yield of the 10-year chart. The yield poked its head up over 2%, went a little bit higher, 205, 207, 208, and then later, I'll tell you in just a second what happened, but by interest rates going up, that can mean a couple of things. That could mean risk. People think things are less risky and they're moving more to equities. The economy is growing, or if they spiked up appreciably higher, it could mean that many countries don't trust our debt. We don't think it's the third. We think that the expectations are that people are thinking that the economy, back to this chart, is really, really picking up steam, which we don't think is the case. Now, here's where I held the carrot out a minute ago, and that is that rates turned back around and went back down, down here, and we'll see what that could mean. Okay, either risk is on, which would speak to what we're about to talk about, or maybe folks are thinking the economy is not growing quite as fast. Potentially, our best guess would be our next, the retail sales. Let's talk about retail sales quickly. Retail sales came in surprisingly good, and we found this very, very positive. I know it goes against what I've just talked about earlier, but this little blip right here is a very good positive data point. And guess what has happened? We've now had the consumer digest the sequestration taxes and the other slowing impediments that maybe have affected many. If this continues, that'll make us more positive about this, and that'll make us more positive about this. We're still waiting with bated breath just a little bit. Now back to our other item. The little country that could, Cyprus. If you've been reading us, you know that we think Cyprus, what happened in Cyprus was very interesting and somewhat maybe unique. For those that haven't been listening or reading, the country of Cyprus had, or is in the process of still taxing folks who had over 100,000 euros in their account. Since they did do that, we thought that it could potentially create a little run on the banks, which it did there. Our capital markets completely yawned. The world capital markets completely yawned. No big deal. Very, very positive. Sometimes it's not what the markets do, it's what they don't do. And this was a super positive thing. Anyway, thank you very much.